Hello, thank you for tuning in. In this video, I'm going to teach you about the leverage ratios, which basically helps us understand how much leverage has the company used. So let us start out by writing leverage ratios. Okay, leverage ratios. So we'll be talking about four main types of ratios in this video. So we'll start out with something called the debt to equity ratio. So this ratio consists of total debt and total equity, and we'll be using the book value of equity here. So what does this equity tell us about, right? This helps us understand what percentage of the assets. So how did we acquire the assets, right? It helps us to understand how we have acquired the assets through the use of too much debt or from too much equity. So let's take an example. Scenario 1 and scenario 2. We have on the left we have $2. The ratio ends up being 2. On the right side we have the ratio end up being 0.5. So the left side seem to be more, you could say it's more riskier. The right side, it is less riskier. What it basically is that on the left side, the assets are the creditors have the most stake in the assets. And on the right side, the shareholders have the most stake in the assets. Okay. So that is what debt to equity ratio helps us to, helps us to understand. Let us go number 2. We have debt to capital ratio. So what is the debt to capital ratio? It is total debt divided by the total amount of capital that the firm has, which is a summation of the total book value of equity, that's what you're using here, plus the total debt. Please see that total debt is on the numerator and the denominator. So this itself, in this form, it helps us to understand like what fraction of the firm's activities are financed through the use of debt. So we want to see, okay, from the total capital, what percentage of that, right, is debt. Right, the more debt we have, which is not good. That means the company is using more leverage. So let's take an example where we have 5,000 divided by 10,000. 5,000 total debt divided by 10,000, which is the total capital, which is a summation of total equity plus total debt. So we end up having about 50%. So this tells us that the 50% is the leverage here. We are using 50% is financed through debt. All the activities, 50% of those is financed through the use of debt. So the third ratio is called the net debt to enterprise value. This is not much different from the number 2 ratio we saw. The main difference here is that instead of using the book value of equity, we use the market value of equity. So we have net debt divided by the enterprise value. So what is the enterprise value and what is the net debt? So net debt is simply the total debt that the company has, the liabilities, minus any excessive cash and short-term investments that the company has. So what we basically do is we use the cash to pay off the firm's debt, and there's still a little bit of debt left out, so that is the net debt. And after that we have the enterprise value, which is equal to the market value of equity plus net debt. So if you see a similarity, the net debt is on the denominator and the numerator, just similar to the second ratio where we had total debt on the numerator and denominator. So this is also telling us what fraction of the firm's activities are financed through net debt, but the main difference is that we are using the market value of equity. Okay, so number 4, we have the equity multiplier, which is total assets divided by total equity. So this is very interesting. This helps us to see how much total assets we have in terms of multiples of the equity. Okay, let's say if right? If the book value of equity, if you're using the book value of equity, then we say it is the book value of equity multiplier. If you're using the market value, it's the market value of equity multiplier. So while I'm writing that, let me also tell another point, right? So it is very important. Yes, another important thing is that this helps us to see how much of the total assets is being acquired by the equity. So these ratios really give us a little bit better understanding of a firm's financial situation and how much leverage it uses, because too much leverage can be detrimental for a company, but it is not always bad if you use it carefully. Thank you for watching this video. If you really liked my perspective on these topics, feel free to subscribe for more awesome content, and thank you. Have a good time.